How do we calculate the yield value? Yield value is calculated based on the profits. The value per share is 124 rupees 80 paisa. So when we divide this assets available for the equity shareholders divided by the number of equity shares, dividend to preference shareholders, then whatever amount remains, out of that I have to pay to the equity shareholders, that is the dividend payable to the equity shareholders. Hello everyone, I am Purnima, faculty in the Department of Commerce and Management, Vidhyaashram First Grade College, Temple of Excellence, MYSURU. I welcome you all to this session. In this session 4 of Unit 4, we will be working out some more problems on the valuation of shares. Now, in this problem, let us see what the balance sheet has to tell us. Now, in the first liability side, we have the equity share capital of rupees 100 each. Amount is 10 lakhs. Then 10% preference shares 2 lakhs, general reserve 80,000, profit and loss account 40,000, sundry creditors 1,20,000. Totally it is 14 lakhs 40,000. Now in the asset side we have the goodwill at 1,20,000, land and building 4 lakhs, machinery 3 lakhs, stock 2,40,000, furniture 60,000, debtors 1,80,000, cash at bank 1,40,000. Total is 14,40,000. Now, the value of the assets is as follows. Now, in this problem, they have given the balance sheet value, that is the book value of the asset, as well as the value of the asset after revaluation. So, the value of the assets is as follows, that is after revaluation. The goodwill is 1,40,000. Machinery, the value of machinery is 3,60,000. Now, in the balance sheet, we have the goodwill as 1,20,000, but the revalued amount is 1,40,000. Now, the machinery value is 3,60,000. Then, land and buildings is valued at 4,50,000 and stock in trade at 2,60,000. Then, furniture at 56,000. So, they are giving us two values of assets. Now, in the asset side, that is the balance sheet asset side, we have a value, and also they are given us the revalued amount. So, we have to find out value of the share as per the net asset value. So, since they have given the assets and the liabilities balances, based on this we have to find the valuation of the share based on the net asset value method. Now, when two values are given, it is mandatory for all of us to just take into consideration the revalued assets. So, we will just work out this problem here. The solution is, the first thing is, we will have to calculation of the net asset available for equity shareholders. Calculation of net assets available for equity shareholders. So, we have three columns here. These two are the amount columns and this one is the particulars column. So, we take into consideration all the assets given. So, goodwill, we will write goodwill 1,40,000. Then land and buildings. Land and buildings is 4,50,000. Next, we have machinery, stock, furniture, sundry debtors. Machinery value is 3,60,000. Stock, furniture, sundry debtors. Stock value is 2,60,000. Furniture value is 56,000. Next, we have the sundry debtors. So, sundry debtors is 1,80,000. So, 1,80,000 into 90% of this. So, 90% of 80,000 equals 1,62,000. 1,62,000. Now, when we add all the total of all the assets, I am getting 15,68,000. Now, I have to deduct the liabilities here. Now, what are the liabilities here? Only sundry creditors is the liability. So, I will deduct the liability less sundry creditors. 1,20,000. So, when we deduct this, I get 14,48,000. Now, less preference share capital. Preference share capital. Now, what is the preference share capital? 2 lakhs. So, 2 lakhs I deduct. So, I get the answer as 12,48,000. So, this is the net assets available for equity share holders. 12,48,000. Now, the value per share equals 12,48,000 divided by 10,000. So, it will be 124.80. So, rupees 124.80. So, the value per share is 124 rupees 80 paisa. So, when we divide this assets available for the equity shareholders divided by the number of equity shares. Now, how do we get the number of equity shares? Equity share capital is 10 lakhs divided by the price of each share. So, the price of each share is 100. So, the number of equity shares becomes 10,000. So, 12,48,000 divided by 10,000, I get 124.80. This is the value per share. Now, the next problem here. So, from the following, calculate the yield value of the share. Now, how do we calculate the yield value? Yield value is calculated based on the profits. So, we have 20,000 equity shares of rupees 10 each, rupees 8 paid up. So, this amount becomes important. So, paid up value becomes important here. Then we have the 12% debentures, rupees 50,000, 1,000, 10% preference shares of rupees 100 each fully paid. Profit before interest and tax is rupees 1 lakh. Rate of tax is 40%. Transfer to reserve is rupees 10,000. Normal rate of return is 12%. So, this is the given data. Based on this, we have to calculate the value per share. So value per share is calculated. Now they have given us the profit before interest and taxes. From this profit, so profit is given. From this profit, I have to deduct the tax. Now what is the tax rate? 40%. So from this, I deduct 40% tax. Then whatever is the remaining amount, I have to transfer it to the general reserve. So from this again I will minus, transfer to general reserve. How much I have to transfer? 10,000 I'll have to transfer. Then whatever is the amount remaining, from that I have to pay to the preference shareholders 10% dividend, less dividend to preference shareholders. Then whatever amount remains, out of that I have to pay to the equity shareholders, that is the dividend payable to the equity shareholders. So we'll do the problem in detail here. So we'll work out the solution. Calculation of expected profit. So what is the profit given? Profit before interest and taxes. It is 1 lakh. So profit before interest and taxes is 1 lakh. From this profit, I have to deduct the debenture interest, less interest on debentures. Now what is the debenture value given? 12% debentures, rupees 50,000. So interest on debentures is 12% on 50,000. 12% into 50,000. So when I calculate 50,000 into 12 by 100, 12 5s are 60. 6,000. So interest on debentures is 6,000. I am deducting. So I get 94,000. Then less taxes. %. So 40% of 94,000, that is 37,600. So you deduct this. So 94,000 minus 37,600, it comes up to 56,400. Then from this we deduct less transfer to reserve. Transfer to reserve 10,000. So we get 46,400. Then less dividend to preference shareholders. So what is the share capital? So 1,000, 10% preference shares of rupees 100 each. So 1,000 into 100, that will be equal to 1 lakh. So 1 lakh. So 1 lakh into 10%. That is 1 lakh into 10%. That will be equal to 10,000. The expected profit 36,400. So, whatever is the profit given, we have to make the adjustments here. First thing is we have to deduct the interest on debenture 6,000. So, we get 94,000. From that, you deduct 40% rate of tax, it gets 37,600. Transfer to reserve 10,000. Dividend to preference shareholders is 10,000. So, expected profit is 36,400. Now, we have to calculate the value per share. So, value per share equals expected profit divided by equity share capital amount into 100. So, this will be the ERR. So, we get the expected rate of return. So, this will be equal to 36,400 divided by equity share capital is 20,000 into 8. 20,000 into 8 will be equal to 1,60,000. So, 1,60,000 into 100. So, when we simplify this, I get 22.75%. So, 22.75%. Now, the value per share. So, we have the ERR at 22.75. Then we have the NRR 12% into paid up value 8 rupees. So, when I simplify this, I get rupees 15 rupees 16 paisa. So, this is the value per share. So, first thing is we have to calculate the expected profit, then we have to calculate the ERR. ERR is the expected rate of return. So, what is the formula for that? Expected profit by equity share capital into 100. So, 36,400 divided by 1,60,000 into 100, we get 22.75. So, 22.75 by 12 into 8, I get the value per share as 15 rupees 16 paisa. So, this is the answer. Now, next we have some information on the rights issue. So, rights issue where at any time a company having a share capital proposes to increase the subscribed capital by the further issue of shares, such shares shall be offered to. See, whenever the company wants to increase the share capital, then if it has the equity share capital, then this already the persons who are having the equity shares of that particular company, they will be entitled to the rights issue. So, these shares will be offered to persons who at the date of the offer are the holders of equity shares of the company in proportion as nearly as circumstances admit to the paid up share capital on those shares by sending a letter of offer. So, the letter of offer will be sent to the existing shareholders whenever the company wants to issue more shares or if it wants to increase the share capital. So, either the existing shareholders, they have a right to the new shares. Secondly, to employees under the scheme of employee stock option plan, subject to special resolution passed by company and subject to such conditions as may be prescribed. So, whenever the rights issue is there or whenever the company wants to have a fresh issue of equity shares, so the first thing is the existing equity shareholders, they are entitled to the rights issue. Secondly, the employee stock option, ESOS. So that is ESOP, that is employee stock option plan. So when employees can have a right to this extra shares which are being offered to the public. And then next, to any person, if it is authorized by a special resolution, whether or not those persons include the persons referred to in clause A and clause B above for cash, or for consideration other than cash, if the price of such shares is determined by the valuation report of registered valuer or subject to compliance with the applicable provisions of chapter 3 and any other conditions as may be prescribed. So other than the existing equity shareholders and the employees, these equity shares can be given to anybody who is able to pay the cash. So this is what we mean by the rights issue. Then what are the advantages of rights issue? The rights issue helps in keeping the control of the company in the hands of the existing shareholders. So the existing shareholders will have the control of the company. Second one is existing shareholders get the benefit of the legal right, especially when company offers rights issue at a price lower than the market price of the shares. So the existing shareholders will get these shares at a price which is lower than the market price of the shares. Third one is issue expenses are lower in case of rights issue. So whenever there is rights issue, the expenses of such issue will be lower, and rights issue gives an opportunity to the shareholders in a company they are aware of. So instead of searching for new companies, already the existing equity shareholders, if they are given new shares, they will be very, very happy because they know exactly what the company is. Next is the concept of share warrant. A share warrant is a document issued by the company under its common seal stating that its bearer is entitled to the shares of stock specified therein. Share warrants are negotiable instruments. They are transferable by mere delivery without the registration of transfer. So they are transferable by mere delivery. Just by handing over the shares, it can be transferred. As a negotiable instrument, mere delivery transfers the ownership of the shares. Coupons are attached to each warrant bearing the dates on which the dividend will be paid by the company, as they cannot know who the shareholder is or who is entitled to the dividends. Warrants are essentially a right or interest in the securities. So the warrant is nothing but it is a right or the interest in the securities. So a share warrant is a document issued by the company under its common seal. So company has to put the seal and then issue it, stating that its bearer is entitled to the shares specified therein. So whoever has the number of shares which are specified in the warrant, so those shares become the shares of the person who is bearing the share warrant. So in this way, the shares can be easily transferable from one person to another, and it will also mention the date on which the company will be declaring the dividend and what is the amount of dividend that person is entitled to, who is the bearer of the share. With this, we come to the end of this session. Hope you have all followed it. Thank you.